All right. When I had gone into the discussion briefly and touched upon the married puts, Edison brought up a question. He said, assuming I opened a married put for QQQ beginning of the year, where would it have been exited when the downturn occurred? It might not have been exited, Edison, but let's go ahead and take a look. I'm going to try it this way so we can see historical. I'm going to go into the back test. This is our trial account. So it only on the trial account, it does give us 2 to 3 months of back testing. We'll see how far back I can go. And I want search by symbol. And yes, how far back into? I'll probably go to the 18th. It's not the best. We'll do another lookup in a moment. More results, expiration. I probably would want. Let's just go full leap. Okay, 2022, 2023, Edison. I know I can't go back further on this account beyond January 18th, simply because of that only 2 to 3 months back in time. And on the real account, it's about 7.5 years or so. But let's just go ahead. Sorry about that. This is going to take faster than I expected. Okay. All right. So QQQ is at 370.55. And I should have gone to all results. But honestly, I kind of like this one here. 385 looks okay too. But the 390, we're 5% in the money, got a risk of 6.6%. Applied volatility is at 0.23. We're probably already in the downturn in that case. But I'm going to use this one. So on January 18th, 370.55, we would have bought the 390 put for around $45, $46.35, I'm sorry, midpoint. Total debit of $417, but I'm guaranteed to get 390 back. So the maximum risk is $27.35 or 6.6%. While we're waiting for that, let's just go to the chart. Let's just see where we are now. So yeah, on January 18th, where am I? 22:18. Yeah, we were already starting the downturn. I apologize. So let's go back. We're going to go back further in time. I apologize, Edison. But we're going to go ahead and see here. But when that comes up, I'm going to show you something. The idea with the married put position, remember, I bought a 2023 leap. It still has 9 months to go, roughly, to expiration. We're showing that we bought it at about here. And no, 370. I'm sorry. It's over here. This is when we bought it. A little bit of a downturn started, but it exceeded further than that. And we had only a 6.6% maximum risk on the position. Here, when the stock was down at 330, we were probably only down 1 or 2%, to tell you the truth. Here, might have been down about 3%, half of it. Here, we're still probably down around 3.1% on the position. We're going to see where we stand right now, having entered this position with those prices. Let's enter it in the portfolio, Edison, to see where we are right now. I'm assuming we're going to be at about a 2.5, 2.7% loss on this married put position. Now, I know we had opened it on January 18th. We're going to take a look at further back, Edison, as well. So, what were my prices again? It was $370.55 for the stock on January 18th. And the 390 was at 46.35 midpoint. Okay. Let's just keep it in here. We're going to enter a married put, Edison. QQQ. 100. Pretty expensive. And 18, right. That's right. 370.55 is the price. And we're going leap. January 2023, almost went too far there. And we were at the 390 put that we purchased. And we purchased that at 46.39 or 35. I'm sorry, 46.35. Can't read my own handwriting. Again on 118. All right, so let's enter that into the portfolio. And what we see here, no adjustments made so far. 3.2%. I'm sorry, I was off. I thought with the increase in implied volatility, I guess volatility did come down. So I think when volatility was higher, this might have been at that 2.7, 2.5% loss that I mentioned. But we know that volatility has been coming down recently in this case. So where am I now? I've lost 5% on the stock, $1,900, and gained about $600 or close to it back on the put. We wanted to add some additional content to enhance the discussion that we had with Edison. We wanted to be able to go back to his preferred date that he asked about, January 3rd, 2022. Here we see a similar married put setup that we saw on January 18th on the trial account. We're about 5% in the money with a risk of about 6.3, 6.4%. With QQQ at 401.68 on January 3rd, we could buy the January 2023 420 put for 46.40. Now our total investment would be 448.08 for this married put position, guaranteed exit at $420, so the maximum risk is 28.08, or that's 6.3, 6.4%. QQQ is currently at 358 as of today, down about 10.9% still. The current liquidation of the married put is only a loss of 21.29 or minus 4.8%. This, of course, is due to having the put increase $22 from our initial purchase price to counter the loss. But what about Edison's question? When would we look to exit the RPM during a market downturn? Well, we saw three distinct bottoms over the past few months on QQQ from if we had gotten in on January 3rd. QQQ hit lows on January 27th. It was down to 341.10, a loss of $60.58 on the security alone, or 15.1%. February 26th, we see a low of 318.26. We're down 83.42, or a loss of close to 21% just on the underlying security. That same bottom is pretty much hit on March 14th. We're down 83.51 on the security, 21%, 20.8% again. Now, using the historical tools on power options, we can view the Analyze Position feature once we've isolated our trade historically. Here we have, again, on January 3rd, 2022 with the closing prices, the QQQ at 401.68 and our 420 put for January 23 expiration, 6.4%. The Analyze Position feature from the historical tools will allow us to quickly see our historical return versus changes in SPY and QQQ, and also the historical stock and option price. Going into the Analyze Position feature, we quickly see the total change on the position since the trade. Right now, on March 25th, we're down 4.9% on the position, while the stock is down about 11.3%. With the market conditions being what they have been, we have not seen a positive return on this position yet since January 3rd. And we do see that a maximum loss was realized on March 14th, that third low that we hit, for a loss of 5.9%. Now, of course, remember the max risk was 6.4%, so we're pretty close to that loss. But remember, the underlying security was down 21%, and we were only down about 6%. Now, below that little graph, we also see graphs of the total return for the position compared to SPX and QQQ, as well as the stock and option price. So we see here on January 27th on the left, there was our return of minus 4.9%. Over on the right here, we can see that the option price had gone up to 85.03 from our original purchase price. And of course, the stock is down to that 341.10. Going to our next low, February 23rd to 24th. Low number 2, remember the initial cost of the married put was 448.08. On February 23rd, we see our loss at minus 5.6, 5.62%. Then we see that the option midpoint was at 93.50. It was gained almost $45 from when we originally purchased the put, and the stock was at 329.42. That 318 price that we saw was the open on the 24th at a lower low than the February 23rd close. However, here we are, still down 19 to 20%. We're only down 5.6% with the married put position. And the last one, March 14th, low number 3. The initial cost of the married put again, 448.08. We see our return, a loss of 5.9%, very near to the maximum loss on the position. Our option price, our put option, is up to 103.47, and the stock's at that 318 level at the close on March 14th. So then directly to Edison's question, when might we have exited? Well, we might not have exited as we discussed briefly in the beginning. In the blueprint, there is a full chapter on when to exit the married put position. One of the concepts is the 20-day mark. If the stock is not meeting your expectations in the first 3 weeks or so, we may consider closing the position, especially if our sentiment has changed. With that, on January 27th, we might have closed for about that 5% loss, but remember the stock was down 15.1%. But there are alternatives. If we just bought QQQ by itself, and we saw the lows hit on January 27th, February 23rd, and March 14th, what would we have done? Well, we might have tried to average down the position. Taking that second low, we might have bought another 100 shares at that 318.26 open price on February 24th. This would have reduced the total cost basis of our original purchase price at 401.68 down to 359.97. But what about the married put approach? With 12 different income methods, we could have used an income method. We saw what gained as our security declined. The put option that we had in the properly structured setup. We could take that profit off of the put and purchase a different put with a lower price. Essentially now we're getting paid to average down the cost basis to be able to take advantage of a new increase in the underlying security. This is income method number 9 of the 12 different income methods. Of course, if we had caught the signals early, we could have added another put to create sort of a straddle or strangle on the position. Yes, this would be an additional cost, but now we potentially have 2 ways to profit to the downside and the upside if the stock recovers, and this would be income method number 12. But let's take a look at that second low on February 23rd and 24th, and what might have an income method number 9 done for us. Again, the original cost was $448.08. $401.68 for the shares. We paid $46.40 for the put. The close on February 23rd, QQQ is at $329.42. It's down $72.26 or 18%. The January 2023 420 put was at $93.50, up from our original purchase price. We could take that profit off the table. We could sell to close the January 2023 42 put for $93.50 and take that profit and buy more protection at a lower strike price. Maybe we buy the January 2023 350 put for $43.18. This reduces the total cost basis, our effective cost per share on our shares of QQQ, by $50.32. Now, the new effective cost basis on the married put, the new effective cost per share on QQQ plus our new put purchase price is $397.76, but we're all the way out to January 2023 expiration. We did lower the effective cost of the stock down to $354.58, even lower than having averaged down at that lower price at the close on February 24th of $318. How would that position look now? Well, if we had QQQ with a cost basis of $354.58 after taking the profit on our initial put, with our new purchased put at $43.18, we now have that total cost of $397.76. And QQQ is trading around $356 today, so the total loss on the position is only 3%. The stock's still down 11.3% from when we originally purchased it. We have lost money on our new put, but we're only at a 3% loss. And our new put that we would have gone down to with income method number 9 on February 23rd is now out of the money. We can use another income method to get premium and reduce that risk further, or we could use income method number 4 to manipulate the put farther to further lower the risk and then still add another income method such as income method number 1 or income method number 6. Clearly here we've seen the benefits of the married put and the radioactive trading techniques. We could have closed that married put on QQQ at any of the three lows and only taken a loss of 4.9%, 5.6% on February 23rd, and 5.9% on March 14th. Just having the shares of QQQ would have been a loss of 15.1% or 20.8%, let's just call it 21% on those other two lows. We had the choice not to close, and we could have used an income method and now be only at a loss of 3%, with QQQ still being down 11%, 11.2% or so. We could have been paid to average down and lower the cost basis with that income method, where if we just had the stock, we'd have to put in another $33,000 or so to get more shares to average the cost down. And of course, the full details of the proper structure and the setup, the when and how and why to use all 12 income methods are described in the blueprint. Each income method chapter contains a full description of what we call the SIGA model, the decision-making process of when and how to use each income method. There's a full chapter on combining income methods. There's a full chapter on exiting the married put position that we showcased before. Also a full appendix, case studies, and much more. So if you're interested in properly controlling risk, having 12 different ways to continue to lower that initial at risk, control the risk even in extreme market downturns, and be able to structure yourself to be set up for an increase in potential back to profit, even if the stock is down from where you originally purchased it, you want to head on over to radioactivetrading.com, click on that products tab, pick up the blueprint,